This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.
Trump slump? Stocks fall hard, posting their biggest drop of the year. Hot sectors plunge as investors worry that the GOP's healthcare revision hangs by a suture, imperiling other key parts of the business-friendly Trump agenda.
Running into rivals, Nike's revenue dropped as competitors stepped up their game in the very lucrative sports apparel industry.
Second acts, why the new retirement maybe did not retire at all. Those stories and more tonight on Nightly Business Report for Tuesday, March 21st.
Good evening, everyone. Welcome. It was the worst day of the year for stocks. The Dow dropped more than 200 points as investors grew skeptical about how quickly things can get done in Washington. President Trump was on Capitol Hill today to help sell the Republican plan to overhaul the health care system. Concerns that the GOP will not get the votes needed is adding to doubts that the pro-growth policies like tax reform will get pushed through anytime soon. Mix in a down day for financials and questions about interest rate policy, and you have a recipe for a sell-off. And the months-long streak without a 1% move, well, it was broken today. The Dow Jones Industrial Average tumbled 237 points to 20,668. The Nasdaq was off 107. The S&P 500 dropped 29. Bob Pisani has more on today's big decline.
It was a sea of red here on Wall Street today, and we saw something that we haven't seen in a long time, a 1% move to the downside in the S&P 500. That hasn't happened since January 30th. All right, so what's behind all this selling? It's clear that a lot of this is continued weakness in bond yields and the dollar from last week's Federal Reserve meeting. Now, that's putting pressure on banks. So, for example, the bank ETF, the symbol is KBE, was down 4%. Goldman Sachs alone shaved 50 points off of the Dow. The second big issue is anxiety, which is building over President Trump's ability to pass his agenda of tax cuts and infrastructure spending and lower regulation. That's the whole Trump agenda right there. Right now, the repeal of Obamacare is standing squarely in the way. There's a lot riding on Thursday's House vote to repeal Obamacare, as these battles are threatening to push out tax reform and more stimulus well into the end of 2017 or even into 2018. Finally, there is some concern on fundamentals. Auto stocks, for example, like Ford and General Motors, and Hertz and Avis, they were all down sharply today over concerns about an uptick in loan delinquencies and weaker used car prices. And also, energy stocks remain weak as oil approaches a new low for the year. You put it all together, and it's a stew of worries for the markets to digest. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And the sell-off spilled over into construction-related stocks as investors questioned, as Bob mentioned, how soon the White House would be able to push through its pledge to increase infrastructure spending. So names like AK Steel, Caterpillar, and Granite Construction will all lower.
A.B. Mendez joins us now to talk more about today's sell-off on Wall Street. He's a portfolio manager at Frost Investment Advisors. Mr. Mendez, welcome. Good to have you with us. You know, a lot of what happened today was that the so-called crowded trades that have been fueling the market up, whether they were financials, the infrastructure stocks, and others, sold off a lot. Should we be surprised at this?
Not at all. And Tyler and Sue, thank you for having me today. I don't think it's surprising at all. If anything is surprising, it's with each successive sell-off in the market as we go through time, the viciousness and the rapidity with which they happen. It seems to be neck-breaking. Maybe it's because a lot of that is driven by algorithmic strategies. I don't know for sure. But the fact that we would sell off the momentum trades, the crowded trades, the Trump trades, deep cyclicals and financials that have really done fantastically since the election, that we get a little bit of a pullback here, I don't think is surprising at all.
As a matter of fact, you kind of separate out the president's agenda from the market, and you're looking at the economy, and it looks pretty good to you.
Absolutely. And people talk about, oh, it looks like the Trump administration might not be able to accomplish 100% of their stated goals. I mean, that should not be news to anyone. This happens in every election cycle. So it seems to me the administration remains committed to policies that will be business-friendly, deregulation, which will be critically important to the financial sector, which arguably has been overregulated for some time now. And that notwithstanding, even before we get some of these stimulative policies, macroeconomic data have continued to be supportive.
Were you a buyer today or a seller today, or neither? Or if you were neither, what would your bias be over the next few weeks?
I was neither, and I'd tell you, we have traded at relatively high valuations relative to history for some time now. That said, again, supported by strong macroeconomic data and the potential for more business-friendly policy, I would be neither unless and until, a few days from now the dust settles. And, if a week or two from now we were 5%, 10% down on the broad indices, we continue to see a lot of opportunity out there in secular growth names, in names that are, strong balance sheets, strong profitability and cash flows, and where we've been waiting for an opportunity to add to positions that we know we like, where we get a better valuation entry point. So would be buying, once the dust settles.
Very quickly, in the time that we have left, does the Fed and a possible 2 more interest rate hikes factor into your forecast at all?
It makes me a bit more cautious on names that carry higher leverage, companies that have more debt on their balance sheet and are going to have to refinance that debt potentially at a higher interest rate down the road. But more broadly, that's the only way it factors in. More companies that carry higher debt, companies that seem higher risk, that are less profitable, more speculative, I'm a bit more cautious because those discounted cash flow valuations use that interest rate as an input.
Right.
Beyond those couple of examples, it doesn't have much impact on the secular growers that we look at.
Mr. Mendez, thank you very much for your thoughts tonight.
Thanks so much.
Mendez is with Frost Investment Advisors.
Nike's competition is intensifying, and that pressured the Dow Component's quarterly revenue, which just missed Wall Street estimates. The world's largest footwear maker earned 68 cents a share, easily passing expectations of 53 cents a share. Revenue of nearly $8.5 billion was up from a year ago, but analysts wanted a little bit more. And with that, shares fell initially in after-hours trading. Sarah Eisen has more on Nike's quarter.
Nike showed just what a profit machine it could be, but when it comes to the stock, investors want to know if the sales growth is going to be enough. That big bottom line beat driven by lower costs and a lower effective tax rate. But sales growth at 5% match estimates pretty much across the world. Nike's getting dinged lately by the stronger U.S. dollar and big competition from Under Armour and especially Adidas. Adidas has had a bit of a business resurgence in North America, nailing the retro chic fashion trend with athleisure. That's why everyone is going to be listening for signs of what Nike has up its sleeve on innovation to get that sales rate back to around 15%, where it was just over 2 years ago. For Nightly Business Report, I'm Sarah Eisen.
FedEx, long considered a barometer for the economy globally, saw higher fuel costs and its e-commerce expansion dent profits. The package delivery company earned $2.35 a share, missing estimates by a big 27 cents. Revenue grew more than 18% from a year ago, though, to $15 billion. Investors, well, what do they want? They want more. More. That's what they want. Shares dropped in initial after-hours trading. Morgan Brandon gives us the one key takeaway from FedEx's numbers.
FedEx's big earnings miss was driven by 3 big factors. One fewer operating day in the quarter, a big expansion of the shipping giant's ground network, which is an investment that's been crucial to keeping up with the e-commerce surge, and rising fuel prices, which marked the first time energy costs cut into FedEx's profits rather than add to them in 2.5 years, or really since the oil downturn. Even so, FedEx saying it expects, quote, significant earnings growth over the next 3 years as those network investments, the integration of its recent purchase, TNT Express, and the growth of e-commerce all begin to finally deliver. For Nightly Business Report, I'm Morgan Brennan.
Great Britain has followed the U.S. in restricting the electronics that passengers can carry on to flights from certain airports in the Middle East. The Department of Homeland Security added the restrictions for a select number of flights after reviewing the latest intelligence on the threat of terrorism. Phil LeBeau has more on the changes and what they mean for people flying to and from the Middle East.
The Department of Homeland Security believes there's a growing threat of terrorists targeting airplanes flying directly to the U.S. In fact, the agency says intelligence indicates terrorists are aggressively pursuing innovative methods to undertake their attacks, including smuggling explosives in consumer items like laptops, tablets, and e-readers. So it's requiring passengers on select flights to put almost all their electronics in checked bags. Only their phones and medical devices can still be carried on board. The rule change covers 10 airports in the Middle East and Africa, which 9 airlines use to fly directly into the U.S., averaging about 50 flights a day.
I have received a number of briefings on an aviation threat, and I'll have to leave it at that for now. But I can say that we have long known that many of our enemies across the world and in the United States see as their biggest target bringing down a U.S. airliner.
The Department of Homeland Security won't say what specifically prompted the change in electronics rules, but events like last year's terror attack in a Brussels airport have convinced the agency and its new chief, General John Kelly, to tighten security.
Having experienced a lot of terror coming out of the Middle East and in the Middle East, that you have to give the administration cut them a little bit of slack on something like this. They would not have done this for no reason.
That means 9 airlines, including the popular Persian Gulf carriers like Emirates and Etihad, will have to make changes on flights to the U.S. Meanwhile, U.S. airlines are not impacted by this electronics ban. That's because none of them have direct flights from the airports in question. It's unclear how long this electronics ban for certain flights from the Middle East will last. But as one senior administration official put it, we're constantly evaluating the intelligence data. And for now, this is the right thing to do. Phil LeBeau, Nightly Business Report, Chicago.
Still ahead, forced to downsize, why the future looks a lot smaller for some big box retailers.
Perhaps no industry is changing as quickly as retail. The upheaval apparent at one of the most heavily attended industry conferences, where digital startups are just as influential as old guard retailers, something that was not the case just a couple of years ago. And it's those large traditional stores like Target and Kohl's that are shifting their strategies. Courtney Reagan reports from Las Vegas.
More than 5,000 retailers, e-commerce brands, and investors are at the Shop Talk conference trying to solve the same problems. Give shoppers what they want, make it as easy as possible, all while growing business. But there's still much debate about the role physical stores will play in the future and how digital players will benefit from this massive shift.
The fourth quarter, the last holiday season, was a really important moment. I think it was an inflection point where that was the end of retail as we know it.
Big box retailers like Target are dealing with the transition in a number of ways, both online and in physical stores. While Target's investing in its smaller than industry average digital business, the retailer's 1,800 stores remain the key focus, including 100 new smaller stores. One will open across from Macy's New York flagship in Herald Square.
We're going after market share right now. And when I talked to the financial community a couple of weeks ago, we said we are going to invest $7 billion of capital and really make sure that we revitalize our stores, revitalize our brand, move into new neighborhoods, elevate our digital capabilities. But Herald Square, I expect, will be one of our best small format stores.
And Kohl's isn't closing stores either. The off-mall department store has 400 more locations than Macy's, which is closing stores. But like Target, Kohl's thinks smaller stores are a better solution.
Sales in stores at Kohl's and other retailers have come down. So to some extent, we have to acknowledge that fact and resize, you should say in some case, open smaller stores and lean on technology a lot to make the experience better.
We'll have brick and mortar. There will be survivors. They'll adopt all this technology. They'll get smarter. They'll have a little better return on investment than they otherwise would have had. but they won't have what they used to have.
While no one knows what retail will look like in the future,
I'd be happy to help you.
Everyone here at Shop Talk is convinced it won't look the way it does today. For Nightly Business Report, I'm Courtney Reagan in Las Vegas, Nevada.
Walmart wants technology to be a bigger part of its strategy. The world's largest retailer is launching a tech incubator in Silicon Valley so it can identify changes that will reshape the industry in the years to come. The company says the current focus will be on virtual reality and automated delivery. Walmart has been overhauling its digital business to better challenge Amazon.
Marriott International has big plans. The large hotel chain wants to expand and buy a lot and sell you more than just a hotel room. And many rivals, well, they're doing the same. Susan Lee takes a look at why the industry wants to branch out.
One hotel every 14 hours, a stunning pace of development for Marriott over the next 3 years. Its closest competitor, Hilton, also has similar plans.
I'll confess, I have equal parts enthusiasm and exhaustion when I use that statistic, because that's a lot of hotels to open over the course of the next 3 years. It is supply growth, to be sure, but think about it. It's about 300,000 rooms. We think the industry globally is about 15 million rooms.
To entice more people to stay, big hotel companies are offering a lot more than just rooms. Everything from urban wellness retreats to dorm-like accommodations for the millennial traveler.
Not everybody's the same, right? It gives them choice. It gives them choice of type of experience, of price point, of number of guests or need state or whatever sort of business school word you would use, right? It's not for every occasion. It allows you to trade up and trade down and have different experiences.
One big disruptor for the sector, the rise of Airbnb. Morgan Stanley predicts the expected growth in hotel revenues will slow 80% more than initially thought, owing to the competition from the home sharing service. But with over 70% of revenue coming from business and travel groups, the world's largest hotel chain doesn't seem worried.
We're absolutely convinced that offering more choice to our loyalty members, to our group customers, to individual travelers is a way of getting them to stay with us more often.
Over 1 billion trips were made worldwide last year, and that's why hotel companies are working harder to build and to provide the experiences that will get the traveler to check in. For Nightly Business Report, I'm Susan Lee in Times Square.
The home builder Lennar says renewed optimism leads to more orders, and that's where we begin tonight's market focus. The company said a pickup in job growth has buyers more confident, and that led to a better than expected profit. Higher home prices and deliveries also helped out, but Lennar did post revenue that missed estimates and said a rise in land and construction costs caused gross margins to decline. Shares fell more than 2% to $51.27. Sales fell for the 7th straight quarter at General Mills. The food giant said results were hurt by fewer promotions and sluggish demand for yogurt and baking products. But profit did top expectations, and the company repeated its earnings outlook for the year. Shares fell just slightly to $59.76.
Lockheed Martin said it is more optimistic than ever regarding its growth prospects under a Trump administration. The defense contractor pointed to the president's call for increased defense spending by members of NATO. This could potentially result in Lockheed Martin receiving more international orders. But shares, well, they still fell by 1% on this down day to 269 even. A U.S. representative has called for the Department of Defense to launch an investigation into the aerospace components maker TransDigm. California Congressman Ro Khanna expressed concerns the company was operating as a monopolist and maybe engaging in fraud and abuse in the defense industrial base. TransDigm down more than 5% following this report to 224.79.
A controversial provision of the Republicans' tax reform blueprint is unlikely to go away. That's according to the Republicans' chief tax writer in the House of Representatives.
My sense is that border adjustability has become a given, that it will be part of the final tax reform plan. And really now the discussions are, how can it be designed and transitioned in a very positive way for importers? Because for the rest of businesses, and I would say for importers as well, looking this strong economy, taxing everyone equally in the U.S., eliminating any tax incentives to move overseas, and making sure Made in America products can compete around the world. Everyone wants that in the final tax reform plan.
The border adjustment tax would levy fees on imports, which is why a number of industries have come out against it. But it's not just big business that's concerned, but small business as well. Kate Rogers has our story.
As the battle over tax reform continues in Washington, some small retailers like Richmond, Virginia-based Ledbury are focused on a key proposal in the House Republican tax plan, the border adjustment tax, or BAT. The proposal favors American manufacturing by levying a 20% tax on items imported into the U.S. Meanwhile, exported goods are not taxed. But for Ledbury, the BAT could be detrimental. The startup sells high-end men's dress shirts, ties, and more online and in its store. But only 2% of its products are manufactured in the U.S. The other 98% are made in Europe.
For our business, that $145 shirt that we make from Italian fabrics that we would sew in Poland, that's going to have additional 20% tax on top of it when we bring it into the country. Now, I think some people might say, hey, 20%, that's not a huge deal. But what not everybody realizes is we're already paying a huge amount of duties to bring these shirts into the country.
Tribble says shifting production to the U.S. would be too costly, and finding a cheaper manufacturer in Asia would cost them quality. So the startup's options are to raise prices or cut hours for workers. The National Retail Federation has warned this will become the norm for small retailers if the BAT goes through, adding the tax will crush small retailers, causing them to lay off workers or even close their doors. While concerns over the BAT have cropped up on Main Street, some advocates point out the benefits in the GOP plan, including a reduction in the corporate tax rate, would not be possible without it.
The blueprint from the House Republicans contains a border adjustment. It has lots of other really good things for small companies in it. It has, unlimited immediate depreciation, so essentially no depreciation, immediate expensing of capital equipment. It has lower tax rates. It has an elimination of the estate tax. So that's the other element of this. You can't look at a border adjustment all on its own. It's not a proposal all by itself. It's within the context of larger tax reform.
At Ledbury, Tribble is hopeful lawmakers will listen to the concerns from retailers big and small before implementing such a major change.
This theory is relatively new, it's untested, and I think it's something that we really need to think about before dramatically changing sort of the supply chains of the businesses in this country.
For Nightly Business Report, I'm Kate Rogers.
Coming up, Encore Careers, why retirement is starting to take on a whole new meaning.
A new study finds that most American workers feel confident they'll have enough to retire on, even as many of them don't have much in the way of savings at all. Among current retirees, financial confidence is even higher, and many haven't actually retired in the traditional sense. As Jane Wells reports, the new retirement is not retiring.
I may bring in the camera close right here.
Veteran Assistant Director Jason Roberts is giving a class to aspiring background actors at Burbank's legendary Central Casting. One of his students is 67-year-old Abe Rogland.
It's fascinating being on set.
Rogland used to own a logistics company, but that went south in the recession. Now he's pursuing his love of acting full-time, partly because he needs the money, and says he's not the only one on the set who does.
A lot of them have cashed out the IRAs already. A lot of them are working now because they have to pay the rent. Social Security is just not making it.
The Employment Benefit Research Institute found that 42% of people working for pay after retirement need the money to get by. But at the same time, almost all of them also do it for fun.
I get bored.
77-year-old Walt Krakowicki retired at age 60 from a career in food services management at Universal Studios. Now he picks up odd jobs as a background actor, not for money, but to keep busy. He even did a scene with Cameron Diaz for Bad Teacher where she washed his Cadillac.
Yeah, she washed my car. I didn't wash my car for about 2 months after that.
The fact is we're living longer, healthier, and more active lives. That's why the Mizell Senior Center here in Palm Springs is a hive of activity. The EBRI survey says at least half of Americans expect to live to at least age 85, and more of us are retiring earlier than expected, but we're not sitting around. People like Sherry Goodlow.
I had breast cancer 6 years ago, and I looked at between 62 and 65, and I thought, do I really want to stay there another few years, or do I want to start really living?
Goodloe ran the numbers, realized that with a little downsizing, she had enough retirement to, quote, start living. Now, through a website called Trusted House Sitters, she house sits and pet sits around the world for free.
I plan to do this as long as I can. I love it.
Retiring is a lot less retiring than it used to be. For Nightly Business Report, Jane Wells, Palm Springs.
And to read more about untraditional retirements, you can always head to our website, nbr.com.
And before we go, let's take another look at this down day on Wall Street. Worst of the year, worst of the Trump era. The Dow tumbled 237 points to 20,668. NASDAQ off 107, and the S&P dropped 29, first 1% losses in many, many weeks, Sue.
Yep. Indeed. We'll see what tomorrow brings. That does it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Matheson. Have a great weekend, everybody. We'll see you tomorrow.
Nightly Business Report has been funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.